Retiring on passive income sounds like a dream, but most people get it completely wrong. They focus on total return or capital appreciation, when what they really need is consistent monthly cash flow hitting their bank account like clockwork. Today, we're revealing 15 ETFs specifically designed to generate monthly income, not quarterly, not annually, but every single month, so you can pay your bills and live comfortably in retirement. This isn't about the highest yields or the riskiest plays. This is about building a diversified portfolio of income-generating ETFs that pay you monthly distributions from dividends, bond interest, covered calls, real estate rents, and other income strategies. By the end of this breakdown, you'll have a complete roadmap to retire with predictable monthly income. The key to monthly income retirement is diversification across income sources. You need equity dividends, bond interest, real estate income, preferred stock distributions, and option premium income, all working together. When one source struggles, others compensate. That's how you build retirement income that survives market crashes and economic cycles. Number 1 is JEPI, the JP Morgan Equity Premium Income ETF, the cornerstone of any monthly income portfolio. JEPI holds large-cap stocks, but sells covered calls on them to generate extra premium income on top of dividends. It currently yields around 7% to 8% annually and pays monthly. JEPI holds about $35 billion in assets with 0.35% expense ratio. The fund owns quality companies like Meta, Amazon, and Visa, but uses covered calls to boost income. During volatile markets, option premiums increase, so GP's income actually rises when you need it most. Number 2 is JEPQ, the JP Morgan NASDAQ Equity Premium Income ETF, applying the same covered call strategy to NASDAQ 100 stocks. JEPQ focuses on technology companies like Apple, Microsoft, and Nvidia, but sells calls against them for monthly premium income. GPQ yields around 9% to 10%, annually paid monthly, with about $15 billion in assets. The higher yield, compared to JEPI, comes from higher volatility in tech stocks, generating larger option premiums. If you want technology exposure with monthly income, JEPQ delivers both. Number 3 is XYLD, the Global X S&P 500 Covered Call ETF, which writes at-the-money covered calls on the entire S&P 500 index. XYLD generates extremely high income, often yielding 10% to 12% annually paid monthly, but sacrifices most capital appreciation. XYLD holds about $3 billion in assets with 0.60% expense ratio. This is pure income generation with minimal growth. In retirement, when you need cash flow more than growth, XYLD provides maximum monthly income from equity exposure. Number 4 is QYLD, the Global X NASDAQ 100 Covered Call ETF, applying the same strategy to the NASDAQ 100. QYLD yields even higher, often 11% to 13% annually paid monthly, because tech volatility generates massive option premiums. QYLD has about $7 billion in assets, with 0.60% expense ratio. The trade-off is giving up most NASDAQ appreciation, but if you need maximum monthly income from tech exposure, QYLD delivers the highest yields available. Number 5 is RYLD, the Global X Russell 2000, Covered Call ETF, applying covered calls to small-cap stocks. RYLD yields around 11% to 12% monthly from small-cap volatility. It holds about $1 billion in assets with 0.60% expense ratio. Number 6 is PFLD, the AAM Low Duration Preferred and Income Securities ETF, focusing on preferred stocks that pay monthly distributions. Preferred stocks are hybrid securities between stocks and bonds, offering higher yields than bonds with less volatility. PFLD yields around 6% to 7% monthly. PFLD holds about $400 million in assets with 0.55% expense ratio. Preferred stocks from banks and financial institutions provide steady monthly income with less interest rate sensitivity than long-term bonds. Number 7 is PFF, the iShares Preferred and Income Securities ETF, the larger preferred stock fund with about $13 billion in assets and 0.45% expense ratio. PFF yields around 6% paid monthly from a diversified portfolio of preferred stocks across multiple sectors. Number 8 is SPHY, the SPDR portfolio high yield bond ETF, providing monthly income from high yield corporate bonds. SPHY yields around 7% to 8% monthly from bonds rated below investment grade. SPHY holds about $6 billion in assets with 0.005% expense ratio, extremely cheap for high-yield exposure. The fund diversifies across hundreds of high-yield bonds, reducing default risk while maintaining high monthly income. Number 9 is VCLT, the Vanguard Long-Term Corporate Bond ETF, providing monthly income from investment-grade corporate bonds with longer maturities. VCLT yields around 5% to 6% monthly from quality corporate debt with 0.04% expense ratio. VCLT holds about $8 billion in assets. Long-term corporate bonds provide higher yields than short-term bonds while maintaining investment-grade credit quality. When interest rates fall, VCLT appreciates in value. Number 10 is BNDX, the Vanguard Total International Bond ETF, adding international bond exposure to your monthly income portfolio. BNDX yields around 3% to 4% monthly from investment-grade bonds issued outside the United States with 0.07% expense ratio. BNDX holds about $90 billion in assets, providing geographic diversification. International bonds reduce concentration risk in U.S. markets and can benefit from currency movements. Number 11 is MORT, the VanEck Mortgage REIT Income ETF, focusing on mortgage REITs that pay exceptionally high monthly dividends. Mortgage REITs borrow short-term and lend long-term on mortgages, earning the interest rate spread. MORT yields around 10% to 12% monthly. MORT holds about $400 million in assets with 0.41% expense ratio. Mortgage REITs generate massive monthly income during stable rate environments. Companies like AGNC Investment pay most earnings as dividends monthly. Number 12 is SREIT, the Global X Super Dividend REIT ETF, holding equity REITs that own physical real estate and pay high dividends monthly. SREIT yields around 7% to 8% monthly from rents collected on commercial properties, apartments, and warehouses. SREIT holds about $800 million in assets with 0.58% expense ratio. Equity REITs provide real asset exposure, inflation protection through rent increases, and monthly income from property cash flows. Number 13 is SDIV, the Global X Super Dividend ETF, casting a wide net for the highest yielding stocks globally. SDIV yields around 8% to 9% monthly from a globally diversified portfolio of 100 high dividend stocks. SDIV holds about $800 million in assets with 0.58% expense ratio. The fund includes utilities, telecoms, energy, and international dividend aristocrats, providing global diversification. Number 14 is DIVO, the Amplify CWP Enhanced Dividend Income ETF, using a unique strategy combining dividend stocks with option overlays. DIVO yields around 5% to 6% monthly from dividends plus option premiums. DIVO holds about $2 billion in assets with 0.55% expense ratio. The fund actively manages both stock selection and option strategies to optimize income while reducing drawdowns. Number 15 is NUSI, the Nationwide Risk-Managed Income ETF, combining NASDAQ 100 exposure with protective put options and covered calls. NUSI yields around 7% to 8% monthly while using options to limit downside risk. NUSI holds about $2 billion in assets with 0.68% expense ratio. The fund buys protective puts to prevent catastrophic losses while selling calls to generate income. It's income with built-in insurance. So there you have it, 15 ETFs specifically designed to generate monthly income for retirement. 5 covered call equity ETFs for equity exposure with option income. 2 preferred stock ETFs for hybrid income, 3 bond ETFs for fixed income diversification, 2 REIT ETFs for real estate income, and 3 specialty income ETFs for global dividends and options strategies. Building a retirement portfolio with these 15 ETFs creates multiple income streams, all paying monthly. You're not dependent on one sector, one strategy, or one type of income. When stocks struggle, bonds compensate. When interest rates rise, floating rate securities benefit. Here's a sample allocation for balanced monthly income. 45% in covered call equities, 15% in preferreds, 20% in bonds, 10% in REITs, and 10% in specialty income funds. That portfolio would generate blended monthly income around 7% to 8% annually. On a $500,000 portfolio, that's $35,000 to $40,000 per year, or about $2,100 to $3,300 monthly. Scale it up or down based on your nest egg size and income needs. The beauty of monthly income is psychological. Getting paid every 30 days feels like a paycheck. You can budget around it. You know money is coming. Monthly distributions let you pay bills as they come due without timing concerns. These 15 ETFs have proven themselves through multiple market cycles. They survived 2022's bear market, COVID-19, and various corrections while continuing to pay monthly distributions. That's the track record you need for retirement income. Remember, retirement isn't about getting rich. It's about having enough income to live comfortably without working. These 15 monthly income ETFs transform your nest egg into a monthly paycheck machine that pays you whether the market is up, down, or sideways. That's true financial freedom in retirement.